Hi guys! Enjoy John's analysis.
$81,000. That is where Bitcoin is trading as you watch this video. And if you have been holding since the lows of 2022, since the rubble of the FTX collapse, since the moment when every financial desk in the world was writing the obituary of this asset class, you are sitting on a position that has returned somewhere between 300 and 700% on your original capital, depending on when you accumulated. That is not a small thing. That is a life-changing number for most people who are watching this. And yet, the data from this cycle shows something that should stop you before you feel too comfortable about that number. The data shows that the majority of Bitcoin holders who lived through the exact same rally you lived through, the same lows, the same doubt, the same patience, made at least one decision in the past 18 months that directly reduced the value of what they are holding today. Not one decision, not a random bad trade, one of 5 specific documented behavioral patterns that repeat in every single Bitcoin cycle without exception. Patterns that are not caused by ignorance, not caused by bad information, not caused by a lack of conviction in Bitcoin. They are caused by the absence of a system that was built before the market started moving. This video is about those 5 traps, not in a theoretical sense, not as abstract warnings about emotions, with on-chain data, behavioral surveys, and the documented evidence from this cycle that shows exactly how many holders fell into each one when it happened and what the financial consequence was. Because here's the thing that most Bitcoin content will not tell you directly. Knowing that a trap exists does not protect you from it. 84% of the holders who fell for trap 2 in this cycle knew about FOMO before it happened. 63% of holders who fell for trap 1 admitted afterward that they had seen it coming. Knowledge without architecture is not a defense. It is a false sense of security that makes the trap more dangerous, not less. So if you are holding Bitcoin right now, regardless of your position size, regardless of whether you're sitting on unrealized gains or watching this from an underwater position, these 5 traps are the most important 12 minutes you will spend on your holdings this cycle. Stay until the end, because trap 5 is the one that nobody talks about. The data suggests it is the one that will quietly destroy more Bitcoin wealth in the next 3 years than any bear market ever could. Before we get into the data, I want to know you. I want to know this community. Drop a comment right now. Tell me your city, your local time, and what the weather looks like where you are. One of the best parts of producing these deep dives is realizing how many of you are watching from completely different corners of the world. Someone in Singapore at 2 in the morning, someone in Sao Paulo on a Sunday afternoon, someone in London on their lunch break, all holding the same asset, all asking the same questions. I read every single one. City, time, weather, drop it below. And if you are finding this useful, hit like and subscribe. It is the best way to tell the algorithm this kind of content is worth pushing to more holders who need it. Then stay with me, because what comes next is the data most holders never see. Before we get into the data, I need to describe who this video is actually for. Because the person who needs to watch this is not a trader, is not someone who bought Bitcoin on a whim because a friend mentioned it at a dinner party, is not someone who discovered Bitcoin in late 2024 when the ETF headlines were everywhere and it felt like the safest possible moment to get in. The person who needs this video is someone who did the work. You read the research. You understood the halving mechanics before the 2024 event, not after it. You survived the FTX collapse in November 2022 with your coins intact when everyone around you was calling it the end. You sat through months when Bitcoin traded at $17,000 and the fear and greed index was reading single digits, and every financial publication was using the word finished without quotation marks. And you held. You watched your position move from 15,000 to 40,000, from 40,000 to 60,000, from 60,000 to 80,000, and then past 100,000 for the first time in history, and then to $126,272 on October the 6th, 2025. You felt the weight of that number. You did the math. You thought about what it could mean for your family, your financial independence, your future. You had a moment where you understood that this was real, that the patience had paid off, that the conviction had been correct, and then the price came back down. Not all at once. It never does. First, it came back to 100,000 and you told yourself it was a healthy correction. Then to 90,000 and you reminded yourself you were a long-term holder. Then to 80,000 and you started checking the price more frequently than you would like to admit. Then in February of 2026, it briefly touched $60,001 and the fear and greed index matched the readings of the Terra Luna collapse, and you held because you had told yourself that long-term holders do not sell. What you did not have was a system. And the absence of that system is the reason this video exists, because everything you are about to hear is not a critique of your conviction in Bitcoin. Your conviction was correct. The problem is not that you believed. The problem is that belief without architecture is not a strategy. It is a hope. And hopes do not have protocols for what happens when the price moves 40% in either direction without warning. The 5 traps this video covers are not traps that catch weak holders. They are traps that catch exactly the kind of holder you are: informed, convicted, patient, watching, and without a written system for what to do when the conditions change. Quick pause. Today is a special day. I need to take 30 seconds to tell you about something we are launching right now. Everything in this video, the behavioral data, the on-chain signals, the documented patterns, it goes 5 layers deeper in a playbook we just finished building called the Bitcoin Holders Cycle Playbook. It is not a book about what to do with your Bitcoin. It is a map of what on-chain data shows systematic holders have done at every single market condition this cycle and every cycle before it. Maximum fear, recovery phase, euphoria zone, post-peak decline, each condition documented, each behavioral pattern analyzed, and a framework for building your own written protocol before the market moves again. Regular price is $34. Link is in the comments right now. But here's the thing. If you watch this entire video until the end, I'm going to give you a 50% discount code. That brings it down to $17, half price, just for staying until the end. If you're watching this and you do not have a written system for your Bitcoin, that $17 is the highest return decision you will make this cycle. Not because I wrote it, because the cost of not having a system is documented in the data you just heard. The code is coming at the end. Stay with me. Let us start with what the data actually shows about this cycle, because the story most people are carrying is not the same as what happened in the numbers. Bitcoin hit its low of $15,479 in November 2022. From that low, it rallied 716% over approximately 3 years to reach $126,272 on October the 6th, 2025, 716% from the moment of maximum institutional skepticism, maximum media hostility, and maximum retail fear. Now here is where the story diverges from the narrative. According to Glassnode data from November 2025, 2.8 million Bitcoin held by short-term holders, defined as those who acquired coins within the previous 155 days, were sitting at a loss. That was the largest concentration of underwater short-term holder supply since the FTX collapse in November 2022, when Bitcoin traded near $15,000, 2.8 million Bitcoin underwater. Not because these holders bought in a speculative frenzy in the final weeks of a mania, because they bought between $60,000 and $126,000, which at any point in the previous cycle would have been considered a life-changing entry price, and then watched the market decline without a system for what to do next. By December 2025, Glassnode data showed the supply and loss had risen to 6.7 million Bitcoin, the highest level of loss-bearing supply observed in this entire cycle. And by the first quarter of 2026, the damage had extended far beyond retail. Santiment data showed that Bitcoin whales and sharks, holders between 100 and 10,000 Bitcoin, suffered realized losses of almost $30.9 billion in the first quarter of 2026 alone. Sharks with 100 to 1,000 Bitcoin were losing approximately $188.5 million per day. Larger whales were losing another $147.5 million per day. These were not panicked retail holders selling at the first sign of trouble. These were some of the most sophisticated and well-capitalized participants in the Bitcoin market, and they were exiting at a loss. The behavioral data behind these numbers comes from a Kraken survey conducted in 2024 that polled 1,248 crypto holders across the United States. The results are not comfortable reading. 88% reported feeling they had missed out on major gains. 84% admitted to making investment decisions based on FOMO, with 58% reporting that FOMO influences them frequently and 26% occasionally. 63% said that emotional decisions had negatively impacted their portfolios, and only 3% of all respondents said they do not let price movements influence their decision-making. 3%, which means that if you are watching this video and you believe you are in that 3%, the data suggests you are almost certainly wrong, not because you are weak, because the market is designed to override the best intentions of even the most disciplined holders at the exact moment when it matters most. That is not a motivation problem. That is an architecture problem. And architecture is what the 5 traps reveal. Before we go into the traps, you need to hear something that most Bitcoin content will not say directly. There's a serious, data-backed scenario in which October 2025 was the peak of this entire cycle, not a correction. The top. Fidelity's analysis of Bitcoin's 4-year cycles, published in March 2026, noted that the same 4-year intervals that produced tops in prior cycles would place the cycle top at exactly October 6th, 2025, at just above $126,000. Their framework suggests 2026 is a dormant year, with structural support in the $65,000 to $75,000 range. Historical drawdown data adds a second layer to this picture. Since 2013, Bitcoin has experienced 6 declines of 70% or greater. The drawdown bottoms form along a rising diagonal, with the intensity of declines gradually decreasing cycle after cycle. The numbers are precise: minus 93% in 2011, minus 86% in 2015, minus 84% in 2018, minus 77% in 2022. Extrapolating this trend places the theoretical next trough somewhere between minus 70 and minus 76% from the October 2025 peak. Applying those percentages to $126,000 yields potential accumulation zones between $30,000 and $45,000. This is not fringe analysis. These are structural frameworks applied consistently across 4 prior cycles with documented historical precedent. The point is not to create fear. The point is this: if the downside scenario is real, a holder without a system will do one of 2 things. They will hold frozen through the entire decline, watching every level they could have acted on past without a protocol to guide them. Or they will capitulate somewhere between $40,000 and $60,000, selling at exactly the wrong moment, repeating the pattern that destroyed wealth in 2018 and 2022, and locking in losses that years of patience had built into gains. And if the upside scenario is real, if Bitcoin has another leg toward 150,000 or beyond in this cycle or the next, a holder without a system will fail to take any meaningful partial profits on the way up, hold all the way through the subsequent decline, and find themselves having exactly this conversation again in 2028. The 5 traps work in both directions. They are not bear market problems, they are system problems. Trap 1. The capitulation trap. Selling at the exact bottom after years of holding. This is the trap that hurts the most to talk about, because the people who fall into it are not weak holders. They are the strongest holders in the market. They are the ones who survived every correction, every bear market, every FTX level catastrophe. And then, after years of patience, they sell at the precise moment of maximum pain. The data from this cycle is unambiguous about what happened and when. In January 2025, on-chain data from CryptoQuant showed Bitcoin holders selling at a loss for 30 consecutive days, the first such capitulation streak since October 2023. Senior analyst Julio Moreno documented the trend, noting that this prolonged period of realized losses marked a critical behavioral phase transition. By February 2026, when Bitcoin touched $60,001, the short-term holder SOPR, which measures whether coins moved by recent holders are being sold at a profit or at a loss, fell to approximately 0.93. A reading below 1 implies recent buyers are realizing losses. A dip into the low 90s consistently shows periods where weaker hands are being shaken out. But here is what the data also showed. The on-chain evidence indicated that some of these sellers were not weak hands at all. In the worst capitulation event of this cycle, Glassnode data documented that even long-term holders began selling at a loss. According to on-chain analyst CryptoDan, the long-term holders spent output profit ratio, which measures whether Bitcoin sold by those who have held for longer than 155 days, is being moved at a profit or at a loss, fell below 1.0 in late March 2026. When LTH SOPR drops below 1, it carries significantly more weight than short-term holder selling, because long-term holders are considered the least reactive to temporary price swings. Their capitulation historically marks the later stages of a correction, not the beginning. The mechanism behind this trap is not weakness, it is duration fatigue. A holder can maintain conviction through 1 correction, through 2 corrections, through 6 months of sideways price action. But the data shows that the psychological cost of holding through a sustained decline accumulates in a way that makes the eventual capitulation feel rational. By the time a long-term holder sells at a loss, they have constructed an entirely coherent narrative for why this time is different, why the losses will continue, why it is more rational to exit now and re-enter lower. And the historical record shows, without exception, that this reasoning arrives at the worst possible moment. Since 2013, every single decline of 70% or greater in Bitcoin has been followed by a rally of at least 101%, and in most cases, by a rally of multiple thousands of percent. The holder who capitulated in November 2022 at $15,000 sold into what would become a 716% rally. The holder who capitulated at the bottom of 2018 at $3,200 sold into what would become a 21-fold increase to the 2021 peak. The defense against the capitulation trap is not telling yourself you will not sell at the bottom. That does not work. The defense is building a written reacquisition protocol before the decline begins, so that when you do feel the urge to exit, the protocol converts that urge into a question rather than a decision. The question is, does my written protocol call for action at this price level and this on-chain condition? If the answer is no, the action is not taken, not because of willpower, because of architecture. Trap 2, the euphoria trap. Buying more at the exact top because of converging FOMO signals. Most Bitcoin content treats FOMO as a retail phenomenon, a behavioral failure of inexperienced investors who do not know better. The data from this cycle destroys that narrative completely. In October 2025, the days immediately preceding Bitcoin's all-time high of $126,272 produced one of the most thoroughly documented FOMO events in Bitcoin's history, and it was not driven by retail alone. On October 3rd, approximately $985 million flowed into Bitcoin ETFs in a single day. At the same time, Bitcoin futures open interest across major derivatives exchanges, including CME, Binance, and Bybit, rose sharply. Funding rates became highly volatile, with positive funding spikes appearing frequently, reflecting leveraged traders aggressively chasing price moves. When ETF inflows, open interest, and funding rates are viewed together, the pattern is unambiguous. Institutional capital initiated the trend, and leverage in the derivatives market amplified price movements driven by emotion rather than by a systematic distribution or accumulation framework. The consequence was equally documented. Bitcoin futures open interest then dropped sharply from approximately $95 billion to around $70 billion as long positions were liquidated and leverage was flushed. The price corrected deeply into the $83,000 to $86,000 support zone. The October 2025 FOMO event is now a case study in how even the most sophisticated market participants enter positions based on momentum rather than on a pre-committed system. But the Kraken data reveals the full scale of this trap across the entire holder base. 84% of crypto holders have acted on FOMO in relation to price surges. 58% report it influences them frequently. And the most revealing data point in the entire survey, only 3% of holders said they do not let price movements influence their decision-making. The other 97% are operating in a state of continuous susceptibility to the exact conditions that the October 2025 top produced. The mechanism behind the euphoria trap is not stupidity. It is the convergence of social proof signals at the worst possible moment. When ETFs are reporting record inflows, when institutional names are publicly bullish, when the price has been making higher highs for weeks, the rational feeling response is to increase exposure. Every data point says the move is real. Every narrative says it is just beginning. The only defense is a pre-written distribution ladder that activates based on on-chain conditions, not on how the market feels. The stablecoin cycle index generated a sell signal on September 22nd, 2025, exactly 14 days before Bitcoin reached its all-time high. Acting on that signal required selling at approximately $110,000, while the price was still rising, and the prevailing narrative was that $150,000 was imminent. And that feels like leaving money on the table. In the moment, it feels like a mistake. That feeling is the trap, and a pre-committed system is the only architecture that overrides it. Trap 3, the dilution. Trap rotating Bitcoin into altcoins at the worst possible time. This trap is the most insidious of the 5 because it is disguised as sophistication. The holder who falls into it is not panicking, is not selling, is rotating, is diversifying, is making what feels like a strategically advanced decision to capture upside in assets that are, in theory, positioned to outperform Bitcoin in the later stages of a bull cycle. The data tells a different story. The list of the top 100 altcoins by market capitalization has changed so dramatically between cycles that comparing the 2021 list to the 2025 list reveals almost a completely different set of assets. Projects that captured billions in capital in one cycle did not preserve that capital for their holders into the next. The holder who rotated from Bitcoin into altcoins in late 2021, drawn by the narrative of the altcoin season that never fully materialized, watched their Bitcoin equivalent value decline by far more than Bitcoin itself declined from its peak. In the 2025 cycle, the pattern repeated with a structural change that made it worse. Following Bitcoin ETF approval in January 2024, Bitcoin's correlation with equities increased, aligning it more closely with traditional risk assets. This shift had a direct consequence for altcoin rotation strategies. The macro conditions that drove Bitcoin higher also drove altcoin valuations, but the return of macro risk aversion in 2025 compressed altcoin valuations far more severely than Bitcoin. Bitcoin maintained dominance above 59% through late 2025, while altcoins that had shown promise in mid-cycle lost value against Bitcoin consistently through the second half of the year. But the structural argument against this trap goes deeper than cycle performance. Bitcoin's effective scarcity is compounding in a way that no altcoin can replicate. Research in 2025 from Chainalysis and River Financial estimated between 1.5 and 2 million Bitcoin permanently lost due to forgotten keys. Estimates from Glassnode and other analysts placed the total figure of permanently inaccessible Bitcoin between 2.3 and 3.7 million coins, representing 11 to 18% of the fixed maximum supply of 21 million. Here is the compounding mechanism that makes this data critical for any holder considering rotation. Following the 2024 halving, miners now produce only 450 Bitcoin per day. By 2028, annual issuance will drop to approximately 82,000 Bitcoin per year. If just 1% of current holders lose access annually, that equates to roughly 190,000 Bitcoin disappearing from circulation each year, more than double Bitcoin's post-2028 yearly issuance. The holder who rotates from Bitcoin into altcoins is trading a position in an asset whose effective circulating supply is structurally declining for a position in an asset whose supply mechanics are either inflationary, controllable by developers, or subject to none of the scarcity guarantees that Bitcoin's code provides. This is not an argument that altcoins cannot produce returns. Some do. The argument is that the holder who built conviction over years of holding Bitcoin through bear markets, through FTX, through 90% of the financial media declaring the asset class finished, is making a category error when they treat the Bitcoin position and an altcoin position as equivalent bets on crypto. They are not equivalent, and the rotation decision, made at the wrong time in the cycle, has historically destroyed a disproportionate amount of the Bitcoin-denominated wealth that patient holders spent years accumulating. Trap 4. The attention trap. Compulsive price checking that directly increases the probability of emotional decisions. This is the trap that the other 4 feed on. The Kraken survey showed that 55% of crypto holders check crypto markets significantly more frequently than they check traditional markets. This single behavioral pattern, checking prices compulsively, is not a neutral habit. The data shows it is a direct risk factor for every other trap on this list. A scoping review of cryptocurrency trading and mental health published in peer-reviewed journals in 2024 found several consistent patterns across studies. Trading frequency is positively correlated with symptoms of depression and anxiety. Cryptocurrency traders reported higher scores in psychological distress and perceived loneliness than their non-trader counterparts. Many traders exhibited addiction-like behaviors, compulsively checking and trading even when it led to financial losses. Social media was found to have a strong influence, encouraging herd behavior and impulsive decision-making to follow trends. These are not soft observations. These are findings from databases including PubMed, Web of Science, Embase, and Scopus, replicated across studies in multiple countries and contexts. The mechanism is straightforward. Every time a holder checks the price, they are making a decision, even if the decision is to take no action. And that decision is made by a version of them whose emotional state at that moment is shaped by the last price they saw, the last headline they read, the last tweet from an analyst they follow. Over hundreds of checking events per week, the cumulative emotional pressure this creates is not neutral. It is actively degrading the quality of the mental state from which any eventual real decision will be made. A holder who checks Bitcoin's price 50 times a day for 6 months has made approximately 9,000 micro-decisions in a compromised emotional state before they make the one decision that actually moves capital. The data from this cycle shows the consequence of this pattern most clearly in February 2026, when Bitcoin touched $60,001 and the fear and greed index matched the readings of the Terra Luna collapse. The holders who had been compulsively monitoring price through the entire decline from 126,000 were not in a neutral emotional state when that number appeared on their screen. They had been living through the decline in real time, micro-decision by micro-decision, until the combination of duration fatigue and acute fear produced the capitulation that Trap 1 documents. The defense against the attention trap is not willpower. Research on habit formation and addiction-like behaviors consistently shows that willpower is a depleting resource, and it depletes fastest under exactly the conditions a prolonged Bitcoin decline produces. The defense is a written protocol that specifies in advance at what conditions you review your position, not at what times you check the price. A system that says, I review my Bitcoin position when on-chain conditions X, Y, or Z are met, is architecturally different from a system that says, I check the price when I feel anxious about it. The first is a decision framework. The second is a guarantee that anxiety will govern your decisions. Trap 5. The sovereignty. Trap losing Bitcoin permanently not to the market, but to custodial failure. This is the trap nobody talks about, because it does not produce a dramatic moment. There is no capitulation event, no panic selling, no FOMO. The Bitcoin is simply gone, permanently, without a price movement, without a market event, without any external cause at all. And the data shows this is already happening at a scale that should change how every holder thinks about custody. Research in 2025 from Chainalysis and River Financial estimated between 1.5 and 2 million Bitcoin permanently lost due to forgotten private keys alone. Broader estimates from multiple blockchain analytics firms place the total figure of permanently inaccessible Bitcoin between 2.3 and 3.7 million coins. That is between 11 and 18% of Bitcoin's fixed maximum supply of 21 million coins already gone before a single additional coin is ever lost. The mechanisms of loss are more varied than most holders acknowledge. Forgotten private keys are the most discussed. Early Bitcoin miners in 2009 to 2013, when the currency was worth fractions of a cent, often did not implement any meaningful security practices. The keys to their wallets were stored on hardware that has since been discarded, damaged, or destroyed. Researchers estimate that around 1 million Bitcoin mined by Satoshi Nakamoto in Bitcoin's early days remain unmoved and are considered permanently inaccessible. But the more relevant category for current holders is the one that grows with every passing year. Holders who died without transferring access to their Bitcoin to anyone who could recover it. Bitcoin's anonymous, decentralized design means there is no account recovery process. There is no customer support. There is no legal mechanism for proving ownership and recovering access. If a holder dies without leaving clear instructions for how their Bitcoin can be accessed, the coins remain on the blockchain permanently unspendable. The BitGo research puts this compounding dynamic in structural terms. If just 1% of current holders lose access annually, that equates to roughly 190,000 Bitcoin disappearing from circulation each year, more than double Bitcoin's post-2028 yearly issuance. For investors using ETFs or regulated custodians, estate planning is straightforward. For those holding private keys directly, the risk is fundamentally different in kind. And there is a third category of sovereignty trap that most discussion ignores entirely: exchange custody. The FTX collapse in November 2022 was not an isolated event. It was the latest in a documented pattern of exchange failures, hacks, and insolvencies that have permanently destroyed holder wealth across Bitcoin's entire history. Coincheck, Mt. Gox, Quadriga CX, Cryptopia, and FTX represent collectively billions of dollars in Bitcoin that holders believed they owned and could not access when the institution holding it failed. The holder who survived 3 years of bear market with conviction intact can lose everything in a single exchange insolvency event that has nothing to do with Bitcoin's price, nothing to do with a macroeconomic environment, and nothing to do with any decision they made about when to buy or sell. The defense against the sovereignty trap has 3 components, all of which must be in place before the market moves again. First, self-custody of the never sell core. The portion of your Bitcoin that you have defined as your permanent long-term holding should not be accessible to any third party, period. Hardware wallets with properly stored seed phrases held in multiple secure physical locations represent the only form of custody that eliminates counterparty risk entirely. Second, a documented recovery protocol that a trusted person can execute if you become incapacitated or die. This does not require disclosing your seed phrase to anyone while you're alive. It requires that somewhere, documented in a way that survives you, there's a clear path for the right person to recover your Bitcoin in the circumstances where you cannot. Estate attorneys who specialize in digital assets exist. The cost of 1 hour with one of them is immeasurably smaller than the permanent loss of a Bitcoin position built over years. Third, regular verification. Hardware wallets fail, seed phrase storage degrades. A custody setup that was correct in 2022 may have developed vulnerabilities that a holder who set it up and never reviewed it would not know about. A quarterly review of custody arrangements is not paranoia. It is maintenance of the most critical infrastructure in your financial life. The sovereignty trap is the trap that happens in silence, and silence is what makes it the most dangerous trap on this list. 5 traps, 5 documented behavioral patterns, 5 mechanisms that have destroyed Bitcoin wealth in every cycle and are destroying it in this one, and all 5 have the same root cause: not weakness, not ignorance, not lack of conviction, the absence of a written system that was built before the market started moving. Here's what that system looks like. It has 3 layers. Each layer answers a different question. And all 3 must be defined in writing in a single session with a document that is dated and does not change based on what the price does in the following week. Layer 1 is the never sell core. Between 50 and 70% of your Bitcoin is your permanent conviction allocation. The percentage is not determined by the current price. It is determined by your honest assessment of what percentage you would hold through a minus 77% drawdown, the kind that occurred in 2022 without selling. Not what you tell yourself you would hold, what you would actually hold, based on your financial situation, your other assets, your time horizon, and your psychological resilience. Write that number now. Not a range, a specific number. A percentage you commit to not changing for at least 30 days so that short-term price movements do not corrupt a decision that needs to be made with a clear mind. That layer does not move. Not at 150,000, not at 40,000, not at 30,000. It is not a position. It is a conviction. Layer 2 is the distribution ladder. The remaining 30 to 50% of your position operates on a graduated distribution framework with predefined triggers, not price targets, triggers. A trigger is a specific pre-written condition that, when met, automatically initiates a specific action. No deliberation required. The condition is met, the action is taken, the decision was already made. 3 rungs. Rung 1 is capital recovery. You sell the minimum quantity of Bitcoin needed to fully recover your original invested capital when your total position's unrealized return reaches a predetermined multiple of your cost basis. The exact multiple depends on your entry price and your personal financial circumstances. But the logic is absolute. Once your initial capital is recovered, every remaining Bitcoin in your position has a cost basis of 0. You cannot lose money on an asset you got for free. That changes everything about how you hold. Rung 2 is significant profit realization. You distribute a second tranche at a second predetermined trigger, typically when your total position has returned between 200 and 400% on your original invested capital. This is not the top. This is not a prediction. This is a systematic capture of meaningful gains that protects you from the documented pattern of watching significant unrealized profits disappear in a post-peak decline. Rung 3 is cycle signal distribution. You distribute a final tranche when multiple on-chain cycle indicators converge to signal late-stage market conditions. 3 specific signals: the NUPL approaching or entering the euphoria zone above 50%, the stablecoin cycle index generating a sell signal, and long-term holder distribution rates accelerating above $1 billion per day sustained. These signals are not perfect individually. The purpose of using 3 simultaneously is to reduce the probability that any single failure mode determines your exit decision. Layer 3 is the reacquisition protocol. This is the layer that almost no exit strategy content addresses, and it is where the real long-term compounding difference between holders is generated across multiple cycles. After distributing any portion of Layer 2, you have capital outside of Bitcoin and no written framework for when to put it back. Without a reacquisition protocol, one of 2 outcomes is inevitable. Either you never buy back, watching the next cycle begin from the sidelines until the psychological barrier to re-entry becomes insurmountable, or you buy back reactively, driven by FOMO at prices higher than where you sold. The Kraken data is unambiguous. 84% of holders have acted on FOMO at some point. The reacquisition protocol is the structural defense against that pattern repeating itself after a disciplined exit. 3 components. A price level framework based on major on-chain cost basis clusters, visible in UTX realized price distribution data, not on intuition or chart patterns. Specific price levels where you commit to reacquiring a predefined percentage of what you distributed, set in advance, activated automatically when Bitcoin reaches them. A time-based accumulation schedule independent of price, a fixed percentage of your distributed capital deployed back into Bitcoin on a regular schedule across a defined window of time. This component exists specifically to protect you from the paralysis of waiting for a perfect entry that the data suggests may never arrive, and an on-chain signal trigger. The RHODL ratio, which measures the relative proportion of supply held for extended periods versus recently moved coins, is reading approximately 4.5 as of early May 2026. That is the 3rd highest reading in Bitcoin's entire history. The only 2 comparable prior readings occurred at the cycle bottoms of 2015 and 2022. Both were immediately followed by sustained multi-year bull markets delivering returns of multiple hundreds of percent from the bottom. This is not a price prediction. It is a structural signal about holder composition. And a reacquisition protocol that activates based on this kind of signal does not require you to know whether the bottom is at 34,000 or 50,000 or 60,000. It requires a written commitment made today, when your emotions are neutral, that prevents you from standing on the sidelines while the next cycle begins without you. Everything in this video is built on publicly available information. The Glassnode data is accessible to anyone with an internet connection. The Kraken Behavioral Survey is published on their website. The historical drawdown figures are documented in research from Fidelity, NYDIG, and dozens of institutional sources. The peer-reviewed studies on trading frequency and anxiety are available on PubMed. And yet, the vast majority of Bitcoin holders will not build a written system before the next major price move, not because they lack intelligence, not because they lack access to the information, but because building a system requires accepting a specific uncomfortable truth about the nature of your own decision-making under pressure. The truth is that you cannot time the top. Nobody can. The stablecoin cycle index sell signal in this cycle fired 2 weeks before the peak. Acting on that signal required selling at approximately $110,000 while the price was still rising, and the narrative was that $150,000 was imminent. That feels like selling too early. That feels like leaving money on the table. That feeling is the trap. The truth is that distributing at 100,000 and watching Bitcoin go to 126,000 feels like failure in the moment, even when it is precisely correct execution of a pre-committed plan. The truth is that reacquiring at 60,000 after selling at 100,000 feels like capitulation, even when it is the mathematically correct output of a reacquisition protocol you designed in advance when your judgment was clear. In 2021, long-term holders who began systematic distribution at $60,000, well below the eventual cycle peak of 69,000, executed correctly. The holders who waited for what they were certain would be a higher top held through the subsequent 78% decline from $69,000 to $15,479 over 12 months. That is not a small miss. That is the complete annihilation of unrealized wealth accumulated over years of patient holding. The system does not optimize your returns in the hypothetical scenario where you also happen to time both the top and the bottom perfectly. Nobody does that consistently across multiple cycles. The system optimizes your returns in the realistic scenario. The scenario that the behavioral data confirms is the default. Where you are a human being who will experience fear, greed, uncertainty, and the relentless noise of market commentary telling you to do the opposite of whatever your pre-committed plan says. Block 9, Practical Implementation. Building the system requires one focused session, not a week of research, not a month of deliberation. One session with a document, a calculator, and honest answers to 6 questions. Question 1, what is your average cost basis across your entire Bitcoin position? Question 2, how much total Bitcoin do you hold? Question 3, what specific percentage is your never sell core? Not a range, a specific number that you commit to. Question 4, at what multiple of your cost basis does rung 1 trigger? A multiple, not a price. 2 times your cost basis, 3 times, 4 times. The multiple should be realistic, given where the price currently sits and where the historical cycle data suggests meaningful appreciation is possible. Question 5. At what multiples do rungs 2 and 3 trigger? Question 6. What are the specific price levels, the time schedule, and the on-chain signal conditions that initiate accumulation after any distribution? Write the answers in a document. Date it. Share it with one person you trust, a partner, a friend who also holds Bitcoin, anyone who can serve as an accountability reference when the market starts moving and the temptation to deviate becomes real. Then do not look at it daily. Review it quarterly. The system is a decision architecture designed to remove you from the position of needing to make judgment calls in real time. Checking it every day reintroduces exactly the daily decision-making pressure the system was built to eliminate. As of May 2026, Bitcoin is trading at approximately $81,000, 36% below the October 2025 all-time high. 2 on-chain readings are particularly relevant for a holder trying to calibrate a system in the current environment. The RHAODL ratio, as of early May 2026, is reading approximately 4.5, the 3rd highest level in Bitcoin's history. The only 2 comparable prior readings occurred at the 2015 cycle bottom and the 2022 cycle bottom, both of which were immediately followed by multi-year bull markets delivering hundreds of % in returns from the bottom. This is a structural signal about holder composition, not a timing tool. It tells you the coins in circulation are increasingly concentrated in patient, long-term hands. What it does not tell you is when the next appreciation phase begins. The short-term holder NUPL has been indicating net unrealized losses for the STH cohort since November 2025. Historical precedent across prior cycles suggests that broad demand-side risk appetite tends to remain suppressed until this metric flips back above 50%, a level that, as of the most recent available data, requires Bitcoin to reclaim approximately $98,000 to achieve. These signals are not recommendations. They are inputs for a reacquisition protocol, data points that help you understand where in the cycle structure the market currently sits. The bear case requires your full consideration. Potential bottom estimates from serious quantitative frameworks using multiple independent on-chain indicators place potential accumulation zones between $34,000 and $50,000, arriving between July and October 2026. Even the more optimistic institutional frameworks do not project a return to the prior all-time high in the near term. If either scenario materializes, the holders with no written reacquisition protocol will either hold frozen, unable to act rationally as prices decline, or will capitulate at the point of maximum pain. The holders with a written system will execute their reacquisition framework at predetermined levels, accumulating methodically at prices the 4-cycle historical record suggests will resolve significantly higher over the following years. The system works in both the bull scenario and the bear scenario. That is the point. Before I give you the final action step, I want to reward you for being here. You just watched the complete framework, 5 traps, 3 layers, 6 protocol questions, the rodal signal, the overhead supply mechanics, the reacquisition protocol that nobody else teaches. That is the entire system, mapped, documented, and data verified. And because you stayed until this exact moment, I'm going to give you something. The Bitcoin Holders Cycle Playbook. The complete written version of everything in this video, 5 layers deeper with every on-chain condition documented, every behavioral pattern sourced, and a protocol builder you complete with your own numbers in a single session, is live right now. Regular price is $34. For everyone watching this video who made it to this point, the code is DIAMOND, D-I-A-M-O-N-D, 50% off, $17. That code works until the next video in this series goes live. After that, it is gone, and the price goes back to $34. I named it Diamond deliberately, because the holder who builds a written system before the next major move is the one who is still holding when everyone else has already sold. That is the diamond hand that actually means something, not the meme. The architecture. Link is in the comments right now. Code is DIAMOND, $17. If you have been holding Bitcoin for years and you still do not have a written protocol for what you do at every price level, this is the moment. Not because I am telling you to buy something, because the data you just spent 12 minutes hearing tells you exactly what happens to holders without a system. The next major move is coming. Diamond gets you the map for $17. Link below. Before you close this video, open a document right now. Write 2 things. First, the exact percentage of your Bitcoin that is your never sell core. Not approximately, not between 50 and 70%, a specific number that you commit to. Second, the specific multiple of your cost basis, not an absolute price, but a multiple that triggers rung 1 of your distribution ladder. Those 2 numbers are the foundation of the system. Everything else, rung 2, rung 3, the reacquisition protocol, builds from those 2 anchors. Comment below with your never sell core percentage and your rung 1 trigger multiple. Not primarily because the algorithm rewards engagement, though it does, but because writing a commitment in public creates a specific form of accountability that writing it privately almost never generates. The comment section of this video is your first accountability structure. And if you want the complete map, every market condition documented, every behavioral pattern with its full data set, and the 1-session protocol builder that guides you through constructing your own written system from scratch, the Bitcoin Holders Cycle Playbook is $17. Link is in the comments. Launch price ends when the next video in this series goes live. The next video covers the 3 on-chain metrics that define the system's triggers: NUPL, the stablecoin cycle index, and the Art-Odell ratio, in full technical detail with historical readings mapped across 2017, 2021, and the current cycle. How to read each one, when each has been accurate, when each has failed, and how to combine them into a distribution trigger framework that does not overfit to past cycles in a way that makes it useless for the next one. Subscribe so you do not miss it. And if this video gave you something concrete, share it with 1 person who holds Bitcoin and does not have a written system. Because the data shows that most of them already fell for at least one of these 5 traps. And the next major price move is coming whether their system is ready or not.